Hey everybody, Economic Ninja here. I hope you are doing great. We're going to talk about banking. We're going to talk about something called infinite banking, like it's forever. Infinite. Guys, it's a new trend. It's picking up on TikTok. We're going to talk about it. Why? Because a rapper got involved. And anytime there's a rapper involved, I go, it doesn't sound too good. It's like, hey, let's get our idea going out there. It's this new crypto project. What are we going to do? Get a rapper to do it. Okay, they'll do anything. It's like crazy. Anytime I sort of see this, I'm like, let's see. I don't know anything about it. Let's read the story. Here we go. Out of Market Watch, because you know that's really credible. What is infinite banking? Here's what to know about this TikTok trend. It says, what is it, how it works, and the things you should know before turning your life insurance policy into your personal bank. Holy moly. Guys, there is a lot of shakeups in the banking system, to say the least. Right now, we are literally in the middle of the greatest banking collapse since 1929. It's already surpassed the Great Recession. Isn't that exciting? I mean, no, seriously, if you're here for the first time, like, things are getting real. And we got to get ready for this, because you've still got some time to get ready for this epic collapse, because there's going to be so much opportunity in this, all right? And stuff like this pretty much tells the truth. All right, here we go. This article is reprinted by permission from NerdWallet, okay? So just want to give credit to the nerds. All right, scroll through TikTok's finance feed, and this is what's really scary. A lot of people get all of their advice off of TikTok. You know, like, all I need is 15 seconds of information, and I'm good. I'm a financial professional. Now, I'm not a financial professional. I'm just an investor, okay? Don't take anything I say serious. But it says here, scroll through TikTok's finance feed and you'll come across the viral videos on infinite banking. Just so you know, they pay for ads and they push it out. I just want you to understand that's sort of how it works. The concept is making a splash on social media, fueled by celebrities like rapper Waka Flocka Flame. Oh man, I love that name. Waka Flocka Flame. Think about this. When anything goes viral, it's usually because they pay for ads, okay? So what you don't realize is they'll put some little hook in front of something. I've never done it. I've actually would like to do it for something that's really important that could help people, but usually it's just to sell you something. And so what they do is they pay for a ton of ads and they put it right in your face, right? That's how they do it. So there's always someone making a bunch of money in the background that's spending literally millions and millions and millions of dollars. That's how all these really big finance people, just wanted to let you know, all these really guys that have just popped out of nowhere in the last year that have like 1 million subs and they have all these views. It's because they've literally spent like $12 to $20 million a year just to get in front of your face. And they say things like, I have nothing to sell you. And then they stop saying that after a few months because now they have something to sell you. This is just how it works. All right, here we go. But infinite banking is nothing new. The term was coined by economist Nelson Nash in the 1980s and outlined in his 2000 book, Becoming Your Own Banker, Unlock the Infinite Banking Concept. The strategy involves tapping into your cash value of certain life insurance policies, like whole life, and treating it as a personal bank. Nash promoted infinite banking as a path to financial freedom and wealth creation, but it's a little bit more complicated than Waka Flocka Flame and TikTokers claim. They're absolutely true. It is pretty complicated. How infinite banking works. Whole life insurance policies usually last your entire life and have a cash value component that grows as a guaranteed rate over time. This rate of return varies among insurers, but it's typically around 5%. Barry Flagg, a chartered life underwriter in Tampa, Florida, and founder of the life insurance research company Veralytic, said in an email, once your policy has accumulated enough cash value, you can begin to take out loans against these funds, which end up in a certain way being tax-free, right? And that's where the concept of banking yourself comes in. When you pay your life insurance premium, a portion, wait real quick, for the whole tax thing, go check with a tax advisor. Don't go anything crazy and say the ninja told you. I'm not a tax professional. But when you borrow money from yourself, it's not a gain. So the IRS goes, oh yeah, there's no gain made there. It's not until you sell the asset, right? So that's why real estate, people make a lot of money in real estate and it's tax-free because they're borrowing against the value of the rising amount of the real estate, until like what we're seeing right now as it's all about to do this. So it says infinite banking takes it one step further. Policy holders pour extra money into the cash value to speed up growth. See, there's a little catch here, huh? Then they treat it as a personal line of credit and borrow against the policy's cash value to pay for large purchases instead of relying on traditional lenders or dipping into savings. But cash value life insurance can be complex and pricey, and infinite banking is a nuanced concept. For these reasons, it's best suited for high worth individuals with a high risk tolerance to match, Flag says. Now, let me just go and say this. My personal feelings about all of this is I've always wondered the day the insurance companies fail, because the insurance companies take your money and they go and invest it, right? So where are all those investments? And that's always something that's really concerned me. I've never personally done this. It's always seemed too good to be true. And for a certain point, it works until it doesn't. And I have a feeling there's some problems in the insurance industry. That's just personal feelings. I'm going to start covering this a little bit more, actually. But see, those insurance companies have literally done a lot of stuff with that money, and it's out there floating around in the form of derivatives somewhere. And I'm going to start getting down to the bottom of this, because I really feel like there's something about to break, and it's just a gut feeling, but it's something I've never done. And I know for a long time it's worked well, but it is very, very complicated. Now, here it says, when turning your policy into a personal bank, this strategy has perks. For example, you don't have to qualify for a cash value loan because you're borrowing against yourself, right? In the same way you do for traditional loans. The money within cash value policies is liquid, and there's no requirement to repay the loan by a set date or at all. If you don't, though, your insurer will subtract the amount you borrowed from the policy's death benefit, leaving your beneficiaries with lower payout when you die. Now, let me explain something too. I know this accrues interest, but imagine when you're borrowing the money from yourself, essentially, right? Your policy, you're literally never going to be able to borrow more than you put in, all right? So you're always going to have to put in more than you borrow. So think about that. If you become your own bank and you just save money, you're like, I'm just going to borrow for myself and pay myself back, you're actually getting the greatest rate of return. Why? Because it's already taxed money, just like the money that you invested in the insurance policy in the first place, and you're able to pull it out tax-free because it's your money, and you're like, I'm just going to pay it back. It's literally this simple. The only benefit there is that insurance, like, oh, it's got some death benefits, so that's good. It's good to have life insurance, but also it's got the added, oh, hey, we may be making 5%, 6% a year on this, all right? So you got to look at it yourself like, is it better to become my own bank and literally become sovereign myself and just save money and put it away, and then I borrow it from it when I need it and I just pay it back? I'd be a responsible human being. Not a lot of people are like that, and they can't do that. That's why they look for schemes like this that are literally, and when I say a scheme, paying people like rappers, like Flocka Waka, and I feel like Fozzie Bear, Waka Waka Waka, literally to promote this, and a bunch of promoters on TikTok, all right? So just, you got to sort of see where all this stuff's coming, see behind the veil. Under infinite banking, the cash value is collateral for the loan, and the life insurance policy is tied to it. All right, so I'm going to read that slowly again. The cash value is collateral for the loan, and the life insurance policy is tied to it. This means you risk losing your coverage if you don't watch the cash value closely. Insurers charge interest on cash value loans too. So what happens if market dips? Things change. Can this be recalled? Can something change? That's what they're telling you very nicely, all right? If you are truly borrowing from yourself, you wouldn't be paying yourself interest, says Daphne Jordan, an Austin, Texas-based certified financial planner and wealth advisor at Pioneer Wealth Management Group. What's more, infinite banking is expensive. So I already like this girl already. For example, a healthy 40-year-old man can expect to pay $7,000 per year on average for a $500,000 whole life policy, according to Quinoxy, an online life insurance brokerage. In most cases, he'd pay premiums every year for the rest of his life. The financial obligations don't stop there. Infinite banking only works when policyholders overfund the cash value. For a 40-year-old man in good health, that means contributing money beyond $7,000 in paid annual premiums. It's common practice in infinite banking to allocate around 10% of your income to the cash value each month, which is no small commitment. Another downside of infinite banking is time. It can take years or even decades to build the cash value you need to start taking out loans without penalty. Point being is this: when you look at these deals and they seem too good to be true, it's because they are. They're paying for tons of ads to go in front of people and to take advantage of them. They're like, give me $10, I'll give you back 1. Literally. Oh, but it's tax-free. Well, guess what? What if you would have not given the $10, put it in your own bank account and said, I need a loan for 1. No, you know what? I want a loan for 2. I'll take a loan. No, I'll just take it all. I'll take the $10 because it's mine and it's tax-free. That's how you need to start thinking. Guys, these are schemes. Schemes. Don't fall for it. Guys, the Economic Ninja's here. I believe in America because I believe in you, and we are all going to go crush it in this next economic collapse. Let's see you later. Now I got to turn it off.